John, thank you.
Thank you, Ben, and it's interesting to be at the Battery Minerals Conference again. I've been here since 2017, and just for the record, it started off as the Graphite Conference. We've decided to let lithium come in, which is good news. But the good thing about all the positive stories about lithium is the lithium-ion battery doesn't work without graphite. So as far as I'm concerned, that's good news. So a little bit about the project, who we are and what it's about. We're developing what we call a Tier 1 project in Tanzania. Now, Tier 1 in graphite really means it needs to be big, it needs to be scalable. And the reason it needs to be big and scalable is ultimately in the battery space, when you're dealing with natural flake graphite, you're back solving the chemistry, you're back solving the crystallography, so you're looking for large homogeneous amounts of the same material. Absolutely the same as BHP with its Newman blend, Rio Tinto if its Pilbara blend, or indeed Hancock Prospecting with their blend. This is about large volumes of the same material. Now, in that sense, we are number 2 in terms of resources, number 2 in terms of reserves, number 4 in reserves, but critically, we've got the largest measured resource, and that really gives us a great deal of confidence out there. So when you start solving it, okay, I now have a decent sized project that I think is scalable. How do I monetize this project? We realised very early on a key part of monetising the project is finding a channel to market, particularly around the battery anode space. So when we looked outside of China, there are effectively 3 anode players of any size out there, and there's POSCO, Showa Denko and Mitsubishi. We hold an MOU with Mitsubishi and we talk to them very regularly, but critically POSCO stepped up and came on board for 15% of the company at the time and a lifetime offtake for the fines from Module 1. So when we look in the world of graphite and everybody says, I've got graphite this, I've got graphite that, what I've got is graphite with customer validation. We know ours works because POSCO paid for it. POSCO are building a whole business around our product. Very, very critical de-risker. So we sit there at the moment, POSCO about 12-13% on the register, sitting in there for a 10 mil prepay and a life of mine offtake. Where that comes in, if you're going to build the project, the build sequence looks something like get qualified. If you're qualified, you get a contract. If you get a contract, you can go to the bank, you can monetize that contract and get a bank loan, and you can go build your project without having to go print a couple of billion pieces of paper in the process. And that's been very much the diagram that we've been following. We're sitting here now, we have all our key government approvals in place, free carriage sorted out, mining licences are issued, and we're now well advanced in the debt process. So we've had debt providers on site. There's been some pretty hefty dialogue between us and various debt providers, and while I can't say too much about it at the moment, I think in the words of Big Kev, I'm pretty excited. So where we sit at the moment, we're at the tipping point. This seesaw is about to tip over and some pretty exciting things are going to happen. So that's the project, the people. If you look at our board, there's 3 of us there at the moment. There's Richard Crooks, ex-Macquarie, ex-EMR, current partner at Lionhead, ex-director from Lithium Power International. Ian Murray built Gold Road from the ground up. Matador Resources, Jupiter Mines. This board has 100 years experience in the resources sector. We've probably got more experience in resources than the board of BHP. We know what to do. We've done it before. Ditto of our management team. Stu, ex-Blue Ocean, so I've got black belt in capital markets. Critical to the team is Daniel Pantony. Daniel was a project engineer at Syrah's Balama project. From Daniel, we're able to hire the first general manager from Syrah's project, who's now our general manager on site. So we're just building out this experience and how to do things. ESG, Ray is leading the charge on ESG, and that's really a binary outcome if you're talking to banks and finance. If you're not going to be ESG compliant, you don't have a project. So not only do we have the project, we've got the people in place to execute. Been asked a few times over the last 2 days, how do you build a graphite project? And it's really simple till you start doing it. The key difference between graphite and any of the other commodities in the lithium-ion value chain is graphite is not fungible. You can't swap a shipload of Balama product for a shipload of Mahenge product. It just doesn't work. You have to go through a qualification process, and the qualification process is all about a manufacturer gaining confidence in a battery. They can give you a 10-year warranty that says the battery's good for 80% charge after 3,000 cycles. Or if you're talking about expandables or some of the other advanced applications, they meet performance specification. For us to be qualified has taken over 600 tonnes of pilot plant work. The last pilot plant cycle was 500 tonnes of ore to produce 15 tonnes of fines that we blew through a commercial scale plant to understand what the economics looked like at commercial. 5 tonnes of SPG that POSCO took 300 kilos out and put it into batteries and drove them to destruction. It's taken 5 years to get there. POSCO were on site in 2018. So while we talk about this great excitement about what's going on in lithium-ion battery space, this qualification lag is really going to start hurting as the demand runs away, which is the perfect segue into where we're going price-wise. In graphite, you produce a basket of prices. We produce around 30% of our material is fines, and that's the natural feed in the lithium-ion supply chain. 60–70% of our material is large flake that goes into large flake applications. Now this gives us a natural hedge. Every day I read the paper that there's some new funky technology that's going to replace the lithium-ion battery. I don't think it's going to happen soon, but if it happens, I go back to my traditional applications for my fines, and my flake business is still intact. If we're dealing with the runaway price scenario, which we hope happens, we end up just more and more of our large flake gets turned into fines as the demand equation moves forward. So we actually got a natural hedge built into our price deck here, and it's pretty unique. We're not reliant entirely on lithium-ion batteries. But if we start digging into the runaway demand scenario, and this is Benchmark's numbers, Benchmark are looking at an underlap as this J-curve builds out on demand. And you can see there the underlap really beginning to build out around 2028. That amber line there is consensus expert forecast. That's Benchmark, it's Wood Mackenzie, it's Fast Markets, and all we've done is scientifically taken the average of those three and looked at their price deck. So we're looking at a price deck here of basically a runaway demand but a flat price deck. Something doesn't stack up there. Either we've called this price way too short or we're overstating the demand. My view, it's probably calling it way too short and price-wise. And the reason I say that is when I look at this has come out from MST, and MST just simply overlaid what's going on in graphite relative to the experience in lithium. And if you look at lithium, when we started to see battery demand, that is a new disruptive demand stepping in there, and it started to account for about 50% of the volume demand of the product, we'd started to see that price run away very, very substantially. And towards the end of this year, 24, we're going to start seeing graphite cross that. The downside argument on that is, what about synthetic? And the answer about what about synthetic is it's about 3 times the price of natural flake. And when you make synthetic, you go through a graphitization step where you keep it at 3,000 degrees C for a couple of weeks. And you start thinking about synthetic as congealed electricity. And if we're dealing with runaway power prices as part of this conversion, we're going to see synthetic go up in prices as well. So I see the substitute increasing in price and a short developing in the feedstock. So we think we're in a pretty good spot in terms of the the price environment. So when you put the arithmetic together about how do you put Mahenge in, and we've used the rhetoric is it is small enough to be investable, big enough to be investable, small enough to be fundable. So we're going in for a 1 million tonne a year module. It's producing about 90-odd thousand tonnes of concentrate, and the basket value of that concentrate's about $1,700 a tonne. So the arithmetic, if you think about this as an investment proposition, this is a 90,000 ounce a year gold mine that's going to produce gold for about $500 an ounce. It's not a bad outcome on its own, but what we do is we take that cash flow, and the base case business says we invested in Module 2, Module 3 and Module 4. We also have the option of taking that cash flow and exploring other portions of the value chain. Now, critically, what this strategy is about is getting to cash flow quickly. Yes, it's nice to go to anode, it's nice to go to some of these other things, but ultimately, if you've got cash flow, you have options. So this is about developing options as quickly as we possibly can. Ultimately, we end up $1.4 billion US dollars post-tax, post-government free carried interest. This is a dividend NPV, so it's actually a real money. So why does Mahenge work? Mahenge works because it's this combination of geology and geography. Mahenge actually sits above ground. This thing sits about 80, 90 metres above the surrounding terrain. And you can see the extensive cover there. It's every bit of about 6 inches. And then you're into primary rock. And primary rock means we end up with super clean concentrate. So we end up with super clean concentrate, not much milling. So we're at 96, 97% straight out of the box. And 60% of our material sits in as large flakes. So the geology gives us a revenue line. Geography gives us a cost line. Now what we're here is we'll run a 220 kV line out to the project, and we'll connect the project to the hydro-powered grid in Tanzania. So suddenly I've locked my power in at 8 cents a unit, and we're not going to change the price, because if we start jacking the price up in Tanzania, we put a lot of other businesses out of business, so we know that price is going to stay low. So I've locked myself in at the bottom of the cost curve because I've gone hydropower locked into the grid. The other advantage is logistics. Ultimately, the products you produce have to end up in the hands of customers. Logistics is a critical part of the solution. We've got a railway line at Ifakara that goes down to the port of Dar es Salaam. Dar's a big import port, and there's container ships hauling empty containers back to Asia. So when we talk costs, we think cost to customer. That's a fundamental difference about where we stand, and that's really why Mahenge sits at the top of the revenue curve and at the bottom of the cost curve. ESG, increasingly a binary outcome. We see the environmental side coming together as green power, dry stack, low strip ratio, the sort of things that really drive access to market. We see the societal thing. We've completed our compensation process. We've got very good relationships on site. And in terms of the governance, as part of the banking process we've been through, we believe we are EP4 anti-quota principle compliant. So where we're at now, strong near-term cash flow. We're at that tipping point. We see POSCO moving to full form agreement. POSCO has massive ambitions in this space, and we see them as a fantastic partner. And that, we really want to start seeing POSCO to move in, so we're expecting something there. Debt financing. It's been an interesting journey on debt financing. As they say, you borrow $1 million from the bank and you've got a problem with the bank. You borrow 100 million and the bank has a problem with you. And that's really been the DD we've been through. We've had to educate banks about graphite. And we're currently, we've had them on site. We're in front of credit committees at the moment. Other options coming in there, because we are talking about a 4-stage module, we've been in a position, we've been really starting to see some inbound inquiries about monetising access to fines from modules 2, 3 and 4. And that's turned out it was a capital initiative, but it's turned out probably to be a very good market initiative, because if we're dealing with a runaway boom and you're qualified because POSCO buys your material, modules 2, 3 and 4 get to have some pretty impressive value to customers who are short of feed. So BKT, where we're at, compelling project metrics. We think reduced execution risk. We're keeping this really, really simple. We're staying at the top of the value chain for the time being. And it's compliant. We've been validated compliant as part of the debt process. So ladies and gentlemen, delivered in full on schedule.